All right. So what are those tax risks? Some of these tax risks. And this is another one. Married versus single. I spoke to, coming out of the class last week or 2 weeks ago, everybody who attends class has an opportunity to have a 50-minute appointment with me to go over questions they have and whatnot, and maybe map out a strategy. So I was talking to this fellow who's very, very bright. I could tell he's very bright. He was a CPA. He had done a very impressive spreadsheet. I see, by the way, people often share their planning spreadsheets with me, and I just love that. It's just so much fun to see. But he said to me, and he'd captured so much, and he said, you know what, you said one thing that I hadn't considered, that when one of us dies, our standard deduction gets cut in half, because he was planning on using this standard deduction. So what's a standard deduction? Let's come back over here. So this right here, the standard deduction, if you don't have tax deductions on your tax returns greater than $27,700, and if you're over 65, you each get another $1,500. If you're single filer, you get $1,850. So if you're plus 65, your standard deduction this year is $30,700. But let's look at something here. I got glare on my tablet. I can't quite see it. Let's just clean up this line because I can't see that. Okay. So it essentially gets cut in half, doesn't it? Or it does. It gets cut in half when one of you dies. Folks, you can argue with me all day long whether and again, you know, I'll workshop this with anybody because I've been in the Slack group for a long time now. I've been focusing on tax efficient planning for a long time now. As I said, I work with some of the smartest people around the country when we go and do our work with the Slack group and these, go through these things. And Dave's group, again, Dave McKnight's a very, very bright individual. But anyway, we do the math. We figure it out. We have some projections. 40 to 45% is where we think that most of you are going to land at your effective tax rate. But if you don't believe that, you have to believe me when I say if you go into retirement as a married couple, one of you is going to die before the other. It's really highly unlikely, very highly unlikely that the two of you are going to go at the same time. And a couple of things happen. Your $30,700 standard deduction goes in half. $13,850 plus one, $1,500. That's half. So the other thing so now that means you're paying more tax. If you're deducting less of your income, you've got more tax to pay. The other thing that happens is this. I want you to look at this really closely. Look at the difference between married filing jointly and single income levels. These marginal rates are the same. 22%. Let's just pick on 22% for a second. For a single filer a married filer can earn all the way up to $190,750 in taxable income before crossing over to the 24% bracket. A single filer is at $95,000. So your taxes will be higher just by the effect of one of you passing before the other. And this is what this person, a very educated CPA, because your income tax rates will be escalated much, much sooner with only as a single filer. And single filers know this because you've experienced it. But as a married couple, you might have been married for 50 years or 40 years, and you're used to filing together. You don't think that really, it could happen, but pen to the paper, it's sometimes challenging to bring to the front of mind. And so your marginal tax brackets come up to higher levels much more quickly, and your standard deduction gets cut in half when one of you's gone. You don't get to carry that standard deduction. And this very bright individual said, I wasn't considering that at all. So that's a big one. Government fiscal issues. So I'm going to try to finish this in a really short period of time. But folks, we're going to talk just about the federal government because we've got a lot to talk about there: Social Security, Medicare, and Medicaid, national debt, and all other programs. But let's not forget about these state pensions. I don't know any pension that for a state that is properly funded. If you know of one, please tell me, because I really want to learn how they did it. I know. So here we are in Pennsylvania, but we have New Jersey right across the river, about 15 minutes across the river. I've got clients all over the country. And these states are underfunded, or excuse me, these pensions are underfunded. There are crises in these states. Right now in Pennsylvania, you don't have any tax on qualified IRA distributions or pension payments. But folks, I don't know how much longer that's going to last. I give it maybe a good 7 to 10 years, and they're going to have to start taxing those. Right across the bridge in New Jersey, that's not the case, right? You have some forgiveness of qualified distributions, but then tax kicks in. I was talking to an individual last week. He's at a 10% income tax in New Jersey. New York's horrendous. There's a lot of states around us, but even I'm thinking South Carolina, or North Carolina. I can't remember. I think it's South Carolina who's got, we average 6% state tax on IRA distributions. So pay attention to these. If you think that I had one client who lived his dream. He retired and he went and moved to the Carolinas, and he has to continue his Roth conversions. And I had to remind him that now we have to add state tax. And he said, geez, I wasn't remembering that. And I said, that's okay, because we were, and we've got it built into your plan. So let's talk about some of the federal programs. So Social Security, pay attention to these. So these are the findings from the 2023 Medicare and Social Security Trustees Report. So this is from March. So you'll see this is Medicare and this is Social Security. Year asset reserves are depleted. Each Medicare and Social Security have trust funds, and there's a study done every year that tells us when those trust funds are going to be depleted. And for Social Security, it's 2033. For Medicare, it's 2031. If that doesn't concern you, you have to pay closer attention, because the amount that's going to be covered for Social Security is just 77% of benefits. For Medicare, it would be just 89% of benefits. So who's going to take that cut? Raise your hand if you're going to voluntarily take that cut of 77% of your Social Security benefits, or only having 89% of your Medicare benefits. Nobody's going to do that. So that we have to close that gap. And there's only a couple different ways of closing that gap. And I'm only talking about Social Security and Medicare. If we have time, we're going to talk about the national debt, which is just, even more out of control. So I thought this was a very good chart. This is a great group to follow if you want to pay attention to these things. But how is Medicare funded? 46% of Medicare funding comes from the general fund, not Medicare payroll taxes. I hear this all the time. Well, Medicare is paid for with payroll taxes. We're only 34%. And by 2052, that reduces down to 25%, and general fund is covering 49%. So that general fund, equals tax revenues, folks. These are payroll taxes, but these general fund equals tax revenues. There's no, there's no slush fund for these things other than that. And then I like this because it tells us where the funding comes from. For the federal government, individual income tax is 54%. And most of that lies, remember those tax rates, 10, 12, 22, 24, 32, 35, and 37%. Where do you think most of that revenue comes from? Well, right about here. And that is the middle class. All right. So the top of the 24% for a married couple is $364,200. I think it is off the top of my head. $189,000. I think it is for married filing joint, single filer. So this is married, and this is single. But I'm not going to, they may not be the exact numbers. You can look at on the website and see what they are. But and then we got to talk about national debt just quickly, right? So we got Social Security, Medicare, and the national debt. I know we're going a little over. So this is a snapshot of where the national debt was at about 8 o'clock or 7 o'clock this morning. $33 trillion. $33 trillion. We're going to show how much it grew, but these were the Congressional Budget Office May 2020 second projections for the cost of the interest, because we owe interest on that debt of $33 trillion, and it grows substantially. Last year, the Congressional Budget Office, this was their 10-year interest projection. and then for 2023 to 2032, and now we look at from 2024 to 2023, another $10.5 trillion. Folks, it's unmanageable, and that's what the fiscal reports have said, that if the current direction of the federal government continues, that it is unmanageable. So here we are with that $33 trillion in total debt, and you can see how it's increased dramatically even in the last decade. Look at that. Debt to GDP, so you can see how that's changed. So it hasn't been this high since really coming out of World War II, right, and into the 50s. But you can see how it's waned, and it just continues to increase. I thought this was interesting. So where debt is held, government bonds are held, like when the federal government issues bonds, who's buying them? So look at the larger portion here, debt held by the public, the 26.3 trillion this in 2023, and rather than intergovernmental holdings at 6 point. So we own most of the debt. And then our interest rates, average interest rate today, 2.23%. But as we've been talking about, these interest rates continue to climb, and that's why the debt gets out of control. So, or the debt payments get out of control. So, who does this fall to? It falls to us, folks. It falls to the tax that we have to pay for the amount of money we have in that tax deferred account. It also will fall to our heirs. So what are the solutions for this? Don't rely on future tax rates to be lower for you when all the evidence shows that they're going to be much, much higher. There's going to be a crossroads, probably close to 2030, where the government says we are in a crisis mode. We need to increase taxes, and it can't just be on those making $400,000 or more. The math does not work. That is not a political statement. That's a math statement. So what are your solutions? Well, Roth contributions. If you're able to contribute to Roth IRAs and Roth 401ks, take advantage of that. Consider taking advantage of that. Roth conversions. Remember, there are no income limitations on Roth conversions. There are no conversion limitations. I hear this all the time. This is another myth. If you have money in your tax deferred bucket, the IRS allows us carte blanche on what we can move, tax advantaged, and we're talking about Roth. We can move conversions as much as we want and as often as we want over however many years of your schedule works for you. All you have to determine is the amount of tax you want to pay. And yes, if you have $1 million sitting here and you do $100,000 in conversion, then you can determine how much that's going to raise your tax rate up into those marginal tax brackets and what tax you're going to pay, instead of ending up in the I don't know tax rate. The I don't know tax rate comes anytime after today, frankly. So consider Roth contributions, Roth conversions. These are the solutions. Look at cash value life insurance or life insurance retirement plans, because it's not just about the tax deferred bucket. It's also about this taxable bucket. So if you have too much money in this taxable bucket, you're going to get dividends and interest and short-term capital gains and long-term capital gains. So you want to shift that money over to the tax advantage bucket as well. You can only do so much with Roth conversions, and these preferable capital gains rates, I think, are going to be in the target way before marginal income tax rates. So those preferable capital gains rates are going to increase dramatically as well, in my opinion. So you can shift those over. So you can only put so much as far as contributions. You can't convert taxable money, right? Your money in your taxable bucket to Roth. You can contribute and bring it down a bit that way. But you can shift an unlimited amount of money really into cash value of life insurance or LERPs. But you have to qualify. So look at those. The other thing people miss is gifting. Gifting to charities or heirs during their lifetime. So I was talking to a new client, and he gives, I think it's $35,000-$40,000 a year to his daughter every year. And I said, how are you doing that? And he's taking money out of his out of his investment accounts, liquidating them, and then sending the money to his daughter. And I said, well, what if instead of liquidating those positions that you hold and you pay capital gains on, your daughter, because she has a much lower income, her capital gains rate could actually be zero. So she could actually pay zero tax on that. So instead of liquidating the position and gifting cash, he could gift the stock, and then she could liquidate it and then pay a much lower tax rate, or maybe even zero. I mean, capital gains tax rates are 0, 15, and 20. You have to pay attention also to the 3.8% potential surcharge up over certain income levels. But if she could fall in at 0, well, folks, no kidding, 0 is better than 15 or 20%, isn't it? Yeah. So look at strategies like that. So I know we've gone over a little bit. It's 11:06. It's a lot of information when you talk about tax. I could probably break this down to about 4 different segments, but I hope you're getting the idea. You got to pay attention. You got to take these critical items, your real expenses, shake out those projected expenses in retirement. That was part 1. Medical expenses, pay attention to these things. Don't be surprised by them. That was part 2. IRMA, income-related monthly adjustment amount. That's not going away. I'm certain that's going to get worse. You can plan around these things. You can solve these problems now if you do proper planning. Identify these critical items. And last, our 4th part of today, taxes. You absolutely have no control of this when you get there, but you have a ton of control on it now. Now, and in the time while you're still, maybe even while you're still working or early in your retirement, but certainly the time that you're still on this planet, you have control over it. There's going to be a point where I'm going to be out of the Roth conversion business probably because taxes are going to be so high. I don't know. And I don't know when that comes, but it's not today. And I don't think it's the next 5 years or so. All right. So if you want to, we've said a lot. I appreciate you all being here. If you have questions for me, you can email us at questions@attleborowealth.com, questions@attleborowealth.com. Once again, that's questions@attleborowealth.com. So you can ask questions or schedule time. If you're a client and you need to schedule time, reach out to us. Let us know. You can call us, whichever works for you. Visit our website at attleborowealth.com. If there's a lot of videos on there, there's a whole resources page. Take advantage of it. That will eventually change over. I'm hoping that's done soon, but we have a whole new website that's being developed for these videos and coursework, and you're going to be able to work through things like this. So I'm excited about that. I hope you appreciate these webinars. Let me know. Send me some feedback. Let me know what your thoughts are if you want to hear something in particular. And other than that, I'll see you next Tuesday, and I hope you have a great week. Take care.